Okay, let's begin. Hello, everyone, and thank you for joining us for our final Pinnacle Partners Fund VIII update webinar before the fund closing on June 30th of the coming month. My name is Jeff Feinstein. I'm managing partner of Pinnacle Partners. I'm joined with my colleagues and partners, Leo Backer, Jill Holman. Today, we're going to be describing to you the final portfolio construction of Pinnacle Fund VIII. We'll talk about the opportunity zone tax benefits as they are still very much actionable. And you'll be receiving a project update, project by project update. Let's dispense with the appropriate disclaimers, page 1 and page 2. And let's take a deeper look at the agenda. So our objective today, first of all, I want to recognize all of our existing investors who have trusted and partnered with us in this process of building the portfolio and executing on the OZ legislation. And we think we have a flagship curated portfolio of 5 projects. We started, and by the way, this is one of several in a series of webinars, but it was almost 2 years ago we started with a singular asset and a thesis. The thesis was to target specific markets. We'll describe those markets in great detail. We had a point of view on certain products. We call them products. We'll describe that. And we had a seed project in Denver, adjacent to the Denver Broncos Stadium District. Systematically and over time, as we continued to raise capital, we continued to identify high quality opportunities and stay within our investment thesis. Our investment thesis was, one, target these particular markets that have the benefits of migratory trends, strong economic diversification, and really a sustainable marketplace for rents and rent growth. We seized upon Denver as a unique stadium district deal. We then landed in Nashville to secure yet another stadium district deal. We also had a particular point of view on build to rent as a unique offering with mortgage rates rising. And then we secured Project 3 and Project 4, representing that product category. And then lastly, and we'll describe for the benefits of our investors, the inclusion of our 5th and final project in Austin to take advantage of the chip boom happening all across the country, but in particular in Austin, as we intend to deliver workforce housing adjacent to Samsung's chip fab. So over time, we've been curating, sourcing, and securing the portfolio. We are now complete with a portfolio of 5. So with that as a preamble, and again, recognition to our existing investors, we thank you for your trust and your partnership. For those that are prospective investors, we offer an extremely compelling opportunity for you to consider in the final 30 days that this fund is available. Leo, if we can go back one slide, stating once again our agenda here. We're going to talk about opportunity zone investing and tax mitigation strategies for even the prior year and this year, of course. Talk about the sources of capital gains, the investment thesis I just described, but will be fully discussed with Jill and Leo in just a few moments. And then lastly, we'll describe in specific detail each and every project and the progress made in the execution of our business plan. So let's now move to OZ investing. For those that are unfamiliar, we still believe this is the most significant and compelling tax shield ever enacted by Treasury and allowed for by the IRS. As you may know, it requires the investment of a short or long-term capital gain to obtain the tax benefits associated with the legislation. We are nearing the conclusion of the investment period of the legislation, as many other 2017 tax cuts have the same timetable, but there's still significant advantages to be had when investing a capital gain. I'm going to start with the most important and compelling of the 3 benefits, and that is tax exemption when you invest a capital gain and you obtain the holding period of 10 years. you then qualify for tax exemption. What that means is there's no capital gains tax on the appreciation of the underlying real estate. So when you look at our Denver project or our Nashville project, and you can project value creation, that appreciation ultimately will be tax-free. And in a rising rate environment, potentially, that is, I'm speaking of taxes, not interest rates, this tax shield can be extraordinarily compelling. So tax exemption is the most significant benefit. The use of depreciation is also extraordinarily tax efficient. So you get to use depreciation to offset income, and there is no recapture. So in traditional real estate, you must recapture and you pay a 28% tax on recaptured depreciation. Because there's a 100% step up in basis, there is no recapture. Again, a very, very compelling tax efficient tool, which we leverage through cost seg and accelerated depreciation. And then lastly, you get the benefit of deferring the tax on the incoming gain. So say you sold some NVIDIA stock, generated a gain, well, and there's an associated tax. That tax is not due until April 15th of 2027. So you get effectively an interest-free loan for the next 2 years. And most importantly, you establish basis in the real estate at the pre-tax amount. So $1 million, $1 million gain. For this example, you invest the $1 million, you create basis in the real estate offering at $1 million, and not the after-tax amount, which would have been approximately $732,000. So those are the sum of the tax benefits for investors. The imputed benefit of these tax advantages can lift the IRR target by 4 to 6%, depending upon your tax bracket. That's how powerful and significant these tax benefits are. So let's move to the next slide. The sources can be from any asset type that the IRS designates as a realized capital gain. And again, it can be short-term. So maybe you were the beneficiary of NVIDIA's ramp and you sold less than 12 months holding period. That's a short-term gain taxed at 39% rates, or long-term gain at 23.8. Certainly stock and certain stocks are at all-time highs, might be worthy of considering a planned sale for just risk mitigation purposes. A real estate sales do qualify, and the OZ is a superior alternative to a 1031, which is typically used. The sale of businesses, and we've seen a lot of mid-market M&A of late, physicians selling their practice, other service businesses getting a significant liquidity event in exchange for creating business value, and they have been actively allocating to the OZ. Carried interest, if you happen to be enjoying carried interest as a form of compensation, anything that's held less than 3 years is considered short-term capital gain. This applies to private equity, venture capital, and hedge fund principals. The OZ is a perfect pair trade if you're generating carry. Crypto nearing highs, even art and collectibles. And then just a call out, and this is how you could mitigate 23 taxes: partnership interest, a partnership K1, which unfortunately we're still receiving this late in the tax season. Partnership K1s may be on a different 180-day clock. So consult with us, please. If you're just received a K1, may be surprised that the entity generated gains you did not estimate, and you could still potentially mitigate 23 tax. Of course, anything that's occurred in 24, you have 180 days to qualify for OZ tax benefits. That means you have 180 days to invest in a qualified opportunity fund like this fund. This fund, again, is closing at the end of June. And we're going to talk to the benefits of, for those attending that are prospective investors, of a last money in situation. So some of our investors joined us early. We had the one seeded asset, as I described. And so the balance of the portfolio was not yet clear or identified. Well, if you consider investing today, you're going to get the benefit of certainly an identified portfolio of 5 projects. You're now going to hear from my partners the progress made in the operational execution of each of the 5 projects. And the money is effectively deployed immediately. So you're beginning to earn preferred rates of return. And this portfolio, as you will see in a moment, one is now in lease up and 2 are in construction. And so these are advanced and a mature portfolio of projects that lead us closer to refinancing. And refinancing gives us an opportunity to return on capital proceeds to our investors on a tax-free basis in lump sum. So we'll talk a little bit about that, but that's our intended strategy, and we're much closer to that event or a series of events than probably any other fund available in the marketplace. So the projects are now revealed, and I'll ask Leo now to take us through again the original investment thesis, the targeting of markets, the selection and sourcing of projects, and completing the portfolio construction. Leo?
Great.
Oh,
thanks.
by the way, I'm sorry to interject. We have a poll question. We could just launch that, and while we do so, I will say, please put your questions in the Q&A box. We will get to all of them at the conclusion of the presentation. So if you'll allow us, just based on the OZ program, and please take a moment and complete the poll. And Leo, while people are doing that, you can, sorry to interrupt, you can continue. Thank you.
Well, now I can thank you, Jeff. Good overview. Thank you very much, and welcome everybody. And we're extremely pleased and excited to kind of be here today and talk about the final webinar, as Jeff mentioned, for Fund VIII. This has been a long time coming. For those of you that don't know us well or haven't heard one of our webinars before, I'm going to take just a couple minutes and just tell you the quick history of Pinnacle and how we got here with this multi-asset fund that we're going to talk about today. We formed Pinnacle just over 5 years ago, before the OZ regs actually were fully baked. And we saw the opportunity to build a company around investing in opportunity zones with best-in-class developers as a fund manager, and really started in Washington, where Jeff and I are based, and then pivoted to California. So our first 10 projects that we funded and our joint venture partners in are all in Washington and California. Of those projects, we have almost 1,500 units of multifamily. We have 1 project that we've built and actually sold. Early days, this was something you can do in an opportunity zone, and if you reinvest those proceeds into another QOF or another OZ project, which we did. And the reasons for selling that is the returns were so beneficial to our investors that we went to them to a vote to see if they wanted to sell this asset, which was to our county in Seattle, which was extremely beneficial. The other projects are workforce affordable housing. We have over 1,000 units of workforce and affordable housing we are either delivering or have finished and leased up. And we have 3 student housing projects, 2 in Cal Berkeley, actually 1 in Seattle and 1 in Spokane, Washington, that are in lease up right now. So a very diversified portfolio on the West Coast, single assets. And, you know, as we were building Pinnacle, we used the best tax and legal experts in the country to help us formulate these joint ventures and execute on the OZ oversight and compliance. We met Jill along the way. Jill also was involved in the OZ space in Washington, D.C. from the beginning. And we talked a lot over the years and found a way that we could work together, because Jill was advising a lot of family offices and working with developers and opportunity zone investments. And we felt there was a huge value for us to find a way to work together, and bringing her in as a partner in our OZ Fund VIII was the way to do it, because now what we decided to do was launch our first multi-asset fund, which a lot of our investors asked us to do because they really wanted to invest outside of Washington and California. They were either overly invested in those markets or they were more interested in markets outside of these, what we'll call a little bit more troubling markets. So that's what we did. We were very careful on constructing locations that we wanted to look at. Jill and I, we don't have the map on here, but we looked at pretty much every major market from mountain states throughout the Sun Belt. And I think we probably looked at over 100 projects to come down to the 5 projects that we're extremely excited to have closed and in this fund. As Jeff mentioned early on, we were very quickly came to our Denver joint venture with Mortensen Construction, which Jill will talk about. We were very purposeful on markets, so we wanted to be in major markets, but not in necessarily downtown urban cores, and definitely not high-rise Class A development. We felt like those are higher risk, they take longer to build, they need higher rents, and fast forward, those are the markets that are seeing the most struggle right now, because there's a lot of competition in those urban cores that everybody was building to a lot of this employment growth. And we all know what's happened in a lot of major cities like San Francisco and Seattle and others. A lot of these offices are shrinking, and the urban cores are suffering because of that. We were focused on the best opportunity zones in these major markets that are adjacent to these urban cores, and up and coming markets, which are really what opportunity zones are. They're areas in need, but not just in need. There's a reason for development. Either they're in stadium districts like Denver and Nashville, they're in next to growing multifamily and mixed use developments like in Charlotte. In Austin, they're close to major employers like Jeff mentioned, like chip plants. So there's and in Avondale, Arizona, it's more of a smaller urban infill development community that has a lot of growth. We also, when we started the fund 2.5 years ago, all of the funds and joint venture partners like Pinnacle had to come in early to capitalize these joint ventures. So you came in, you close your joint venture to close on land or to true up on the land if a sponsor already owned it. And then we capitalize pre-development, design, permit, and then you build the project. So there'd be a couple years before you were really out of the ground. And that's really was development, what you had to do in those days, right? So Denver, we've been in that project for 2 years. Today, you'll hear from Jill a little bit more detail. We're under construction and we'll be complete in just under a year. Today, our last 2 projects that we have funded, we're able to come in later. In Austin, you'll hear about that project is truly shovel ready. They have a GMP from their general contractor. That's a guaranteed maximum price contract. So you're de-risking that cost of the project. You've got the permits in hand, and they have a construction load to build the project. So more certainty on delivery for sure. And in Charlotte that you'll hear about, we are purchasing finished townhomes from Pulte Homes. So we're acquiring these assets at a fixed price. So really the risk we're taking is now on lease up in a market that we underwrote and that we believe in. So the last money in, as Jeff mentioned, truly is now this fund of 5 with Denver, which is under construction, Avondale, Arizona, build to rent under construction, Charlotte, those townhomes are now completed and in lease up. And you'll hear about Austin, which is shovel ready from Jill, and Nashville. So we're extremely pleased about this curated portfolio in markets that, you look at the map, when people have reached out to us, frankly, and said, why are you investing in Austin? It's one of the most overbuilt markets in the country. Well, you'll hear from Jill that the data that we have received and believe in for our particular submarket in Austin, frankly, if it was delivering today, we would be concerned. But 2 years from now, we believe that submarket is going to be extremely tight to deliver workforce housing in that submarket. So with that, I think I'll let Jill kind of take the reins on talking quickly about each individual project, and we want to leave plenty of time for question and answer on specifically on these projects specifically or in the fund in general.
Great. Thanks, Leo. So we'll first start with our Denver project. So as Leo mentioned, the Denver project is in the Stadium District, and that is really walkable to the Denver Broncos Stadium. What's very exciting is we really sit at the front door of the Platte River, the Platte River Trail, which is a trail that runs to downtown Durham or downtown Denver, and is really a frequently used trail where people can hike and bike. And so for a city that's prides itself on outdoors, it's awesome that we are sitting right there at the front door. And you'll see right here at where the star is, this is the conceptual drawing of the district stadium district master plan. So these buildings do not exist, but that's future development that can take place. The star right here is we're right at the stadium district, and really part of this proximate to the master plan. And you can see the proximity to the Platte River Trail. Across that river trail, you'll see at the very edge and kind of further into downtown, we are walkable to colleges that serve in Denver. And there's about 43,000 students associated with that. And in addition, there's been tremendous population growth within the city of Denver. And so the city of Denver between 2010 and 2020 has grown by 20%. And that's reflected in a latest analysis that was released by CNBC, that there is a housing shortage of 70,000 homes for Denver because of all of the population growth. Our project is a mix of studios, 1s and 2 bedrooms. You'll see here the project is under construction, and we'll have fantastic views looking into downtown, looking into the stadium, or looking over the mountains. So really just depending on whichever view that you want, we'll be able to accommodate. And we've been working with Greystar from the onset of this project as our property management company. Our units will deliver in the first part of 2025. So we've been very pleased with our development partner, Mortensen, and our general contractor, Mortensen Construction, on that project. So cool. The next one that we will talk about is Noted Junction, is our Rev Noda, which is in Noted Junction. So the Noted neighborhood is short for north of Davidson, or North Davidson. And it's a build to rent project, so 68 unit townhome community. So it's purpose built 68 units of rental community. And it's Class A townhomes in the highly desirable area of Noda. And so you'll see here, right here is our leasing website. So this project, as these townhomes are being built and delivered, we are acquiring them. And so of the 68, we've acquired almost all of them. So we're about closed on about 55. And then those townhomes we finish up for purposes of opportunity zones. We have to kind of quote finish construction, and then we are leasing them up. So this is a project that is starting to cash flow, is in lease up. And what you'll see here in the Sugar Creek area next to Noda, we do have a light rail station, and there's just a lot that's happening in terms of mixed use development. And that's very, very exciting, since we're really one of the only projects that will be townhome rentals. So I think these apartments will serve as a demand attractor, I think. So attracting and being a source of supply for the population growth that's really been centered in financial services, Bank of America, and then also with this new development bringing in a lot of retail as well to serve the population growth.
And for those that are new to us or have not been on our webinars before, we had an earlier webinar on build to rent specifically with our sponsor, Trilogy Investment Company out of Atlanta, who is a build to rent developer. So we're happy to send you that link if you email us to that webinar, because it's very interesting. We're very bullish on the build to rent product type, and very bullish when they're urban in nature, when they're close to and walkable to amenities and growth areas like this in Charlotte.
So our next project is Avondale. So that's about 25 minutes from downtown and also the airport, and it's right near I-10, right near the highway. So it's considered a suburban submarket of Phoenix. Interestingly, it's very difficult to get, and was very difficult to get our site plan approved, but we were able to receive site plan approval. But we think it bodes well for I think slowing the construction pipeline whenever we have that experience of, site plan approvals being difficult to receive. But we did receive it. We are under construction. So we are under horizontal construction, so preparing the site. This will be 107 purpose-built single-family home community. So it'll be, as you can see, it'll be fully amenitized. And this is really an infill site. So we are, you'll see this mixed use project here, where we are one part of the mixed use project. So we're the build to rent part, but there will also be a hotel, some additional multifamily, so not built to rent, but just traditional multifamily, and some office. And then this is walkable to retail. It's just outside the picture, but it's walkable to retail in Phoenix. And this project we have set to homes will start delivering in 2025, and we'll be leasing those up second quarter of 2025. With Nashville, Nashville is exciting market. I'm sure you all have been reading a lot about the growth of Nashville in the market. And this project sits on the East Bank of Nashville. And so interestingly, this is a site, and this is what I like about a lot of cities, is when you're just on the other side of the river, you might not be in the downtown, but you get views into downtown. And that's, in my view, some of the best real estate is when you're on opposite of downtown, you look right into downtown, and that's really where this project is. So we are sandwiched between Oracle's campus and the new Titan Stadium. So it's really an exciting location. It's phenomenal location, and you all may have read about Oracle bringing and consolidating its world headquarters into Nashville. It's into actually the East Bank location. So that's tremendously exciting. This gives you an overview. So on the East Bank, there's been development that's taking place, and so there's redevelopment that's taking place. And so we are excited about what our opportunities are there. And with this project, this will be a land position project. So we are expecting to start our, we're in pre-development, expect to start our construction for that in 2025. The city has indicated that they do need to acquire a part of our site for a road. And so we've started discussions with the city of Nashville about that acquisition. And we'll still have buildable site for ample multifamily once we sell a portion, a small portion for the road construction. And so that's
and Jill, maybe what I'll add is we knew this potential taking of the road was going to be in play when we put together our partnership. So we have constructed our joint venture accordingly, knowing that that was the case. So we're going to have a very low basis in the land in here for our fund to go forward on this development. So we're extremely bullish of this site. Number one, like Jill said, it's right in the middle of Oracle's new headquarters, the stadium district growth with billions of dollars of real estate that's being developed around us. And frankly, if we were downtown, as Jill mentioned, let's let everybody else build there and fight with each other on that product. We're building more market rate housing that feeds to downtown and feeds all the employers, like our typical projects that we invest in. So we're extremely bullish of this project. But it will be a land position at a low basis, we believe, and then we'll be raising a separate fund to go vertical on this project, towards the end of this year or first of next year.
And thanks for that, Leo. And you can see here in this map, the one where you see the Oracle is an orange one. The number 5, I think that's an S, is in navy. And then you'll see the gray numbers are the stadium. So you really see just the terrific location and where we are approximate to those economic drivers. Our final project, as Jeff alluded to, is a project in Austin. And so this project is in Northeast Austin. It's 288 market rate units. So this is really a slab on grade surface park project, but it's fully amenitized and with Class A finishes. It's just 5 minutes to the Samsung campus. And as Jeff indicated and mentioned, this is Samsung is continuing to make, then now it's been announced the US government is making significant investments into the greater Austin market for their chip factory. And so Samsung's campus, an office campus, is just 5 minutes away. And so this project is, as Leo mentioned, we have our GMP, we have our construction loan ready, and construction loan closed. So we're really ready to start construction with this project. And then you'll also see the other economic drivers. It's near Tesla, which is to the east. And then you also have the airport, so I guess northeast, and then you also are about 15 minutes to downtown campus. So you're really near, Apple, Tesla, Dell. You're right on top of Samsung. So you see the growth in the Austin market. And as Leo mentioned, our rents here are just about $2 a square foot. So somebody can work at the Samsung campus, do very well and not pay a significant amount of rent and, have your pool, have your Class A stainless steel appliances and Class A finishes. And so we think this product is perfectly situated to accommodate the growth in all of this technology sector in Austin. And so we're very excited about this project. And Stillwater is our development partner here. And Stillwater is our partner on our Nashville project. And so you'll see really thematically where we connect with strong developers and tend to do repeat business with them, just as we're partnered with Trilogy on our Avondale project. In our Charlotte project, we're partnered with Stillwater on Nashville and in Austin as well. So with that, I think I'll hand it back over to you, Leo, to add.
Yeah, I just want to add just a minute about kind of Pinnacle's process. So once we complete our joint ventures, we are very active in project oversight. We bring on kind of what we call owner reps that really oversee the construction process for us. Jill and I are on all of these OAC calls with the sponsors or get reports from them. Once projects are under construction and certainly in lease up, we're on all the leasing calls. Jill's very involved in design for Denver, for instance, on branding and unit mix design. So we're very involved in the development process and property management interviews. We're very involved in who we're using on that front. So we're a very active manager throughout the entire process. So we're very excited again to have, one that's in lease up in Charlotte that we're on weekly calls. We literally, every time there's a lease, we get an email we're very excited about. 2 that are under construction that we're on OAC calls and soon to be in lease up. And then these last 2, we're hoping to break ground in Austin this summer. Again, it's shovel ready. So that's kind of contingent upon closing the fund and raising the capital. Our plan is to raise it by the end of June. We'll start construction in July or August. And then Nashville, as we mentioned, once we get through the city process, we'll get back to the table, get the project going again, and likely would start construction first of the year, early next year.
Right.
So that's the portfolio construction and updates. Jeff, maybe we'll kick it back to you. And I know there's a couple questions.
Yeah, we'll get to the questions. So let's continue to post those questions, please. And in summary, if I may put a capstone on this, what we've discussed here is over time, we sought to participate in superior locations and markets. We believe the 5 markets are some of the most attractive in the country. We wanted to curate a diverse set of projects. So you heard about 2 stadium district deals, 2 build to rent opportunities, and a workforce housing opportunity situated next to the growing Samsung facility, which, by the way, got the benefit of grant from the CHIPS Act and a $45 billion CapEx commitment from Samsung. There are positive market trends in each of these locations. We've got all the comp analysis. If you're interested, our diligence and data room is full of materials that anyone can review in great detail. And so what we now have is a balanced risk portfolio and profile here that we think is extremely attractive. And then again, for prospective investors, there's that last money in opportunity, and let this serve as a material update on the progress made and as the portfolio advances. So one of the questions, we'll move to Q&A now, is about water rights. And it's a big issue, I know, kind of nationally, and specifically in Texas and Phoenix, Jill. So can you comment on, one, our diligence process to identify water rights issues, and is either project impacted by water rights?
No, it's really not a project. We're served by the cities of Avondale. We're served by the city of Austin. So it's not an issue. It's also we are, as part of our diligence, we engage in third-party peer reviews of the reports, plus engage in a construction manager to run an analysis on the constructability of the project, both in terms of plans as well, budget and schedule. So our peer reviews include third parties like environmental, phase 1, phase 2, geotech. We then, in addition to that, conduct an analysis. We engage with a property tax, national property tax consulting firm to do a property tax analysis, because particularly in Texas and just, every state, it's a very significant line item. And so a miss on property taxes is very significant to the NOI. And so we do our own separate tax analysis utilizing Ryan, a national tax advisory company. And so they produce that report. And so throughout the process, we're communicating with our development partner on the status of all these reports. We'll have calls. We might have calls with our consultants and the developer to provide feedback. In addition to that, then we have our law firm, which we've used, Greenberg Traurig, to do an opportunity zone compliance analysis, in addition to our standard, tax analysis and zoning, and evaluating all of the underlying development documents to ensure that our developer is going to be able to move forward with the project that is being proposed and shared with us. So it's a very robust analysis and process that we run. And so just, to finish a point, that hasn't been an issue that's come up in any of the projects that we're working on.
Excellent. Thank you, Jill. So there's another question here related to cost seg, and I'll up-level the question then to the subject of depreciation, use of depreciation. One of the major benefits of the OZ tax incentives is to provide depreciation offsetting income without recapture. If you're not familiar with recapture, I can provide a very simple example. You go out and you buy a large Yukon style truck for business purposes. You can write off on accelerated basis almost the entirety of your purchase cost. And then say you sell it the next year, you need to recapture that depreciation because you haven't, and concluded with the schedule of depreciation. So that's called recapture, and there's a tax associated with that. But in an opportunity zone, there is no recapture, again, because we do 100% step up in basis. So with all that as a preamble, Jill, can you talk about the use of cost seg, just generally speaking, being applied to each of the projects?
Yeah, so
Cost segregation studies.
well, it's been in my experience that, there's cost segregation studies that can be done upon completion where they find out, the different components of the project and the schedules on which they can be depreciated. Our development partners are similarly aligned to depreciate the assets and to shield income taxes just like we are. So we'll be working with our development partners to, and all of us at Pinnacle are similarly and want to reduce our property taxes. So we'll be working with our development partners, working with our tax partners, and legal and accounting partners to figure out the best way to go about doing it and the appropriate way to go about doing it.
And if I may interject, all of that depreciation, whatever is calculated and determined, will be reflected on the K1 that we distribute. And also remember, this is an audited fund. So we've got belt and suspenders up and down with our tax advisors.
Yep.
Okay.
Jeff, I see 3 questions around Nashville. So do you want me to kind of combine those kind of high level?
Yeah, absolutely. I was gonna say, and just to be clear, that we landed in Nashville before the Tennessee State Legislature approved the $2.5 billion bond initiative to renovate the Titan Stadium. Not only did we land there, we secured the land, not to overuse the term land, and so we established what we think is an extraordinary basis. And so some of the land will be taken for eminent domain purposes, enlarging a roadway. And yes, Leo, one of the first questions here is, does that decrease the number of doors in the design of our project?
Yeah, and I see a few questions here on that project. So let me kind of hit high level. Again, when we closed on our joint venture, we knew this road was potentially coming through our site. So we had planned for, in our joint venture, we think very good terms with our sponsor for optionality in the event that happened. And where we are today is we were going to build about 380 units based on the original plan with the land we purchased. But before we closed, knowing the road was coming through our site, we had a redesign done that we're closer to Jill's at 300 units, 320 units, I believe.
Yeah, correct.
Which we actually think is a better scale and scope for that market. 400 units is a lot of units. And our basis in our land will go down because of the condemnation that's occurring, or eminent domain that's occurring. And we feel that at the end of the day, with what we're hearing with the appraisals that are happening right now, with our land basis, as Jeff mentioned, and the size of the project, it's going to be a much more deliverable asset with better returns. Brett asked about another fund potentially to raise the equity needed to go vertical. We're closing our fund June 30th. It's been 2.5 years. I think it's kind of, we've had one extension that we were allowed to do. So we would have loved to include the capital, raise in this fund for that project, but we won't be doing that probably for another 6 months. Once we get through the taking process, we get the design of the project completed and priced out, we'll bring in other equity to go vertical. We will be in this project for, over 2 years. So I think that will allow us to bring in, another OZ fund that we will manage and or other equity to build this project for us. And we're really going to have our eyes on the approximately $6 million that Fund VIII has invested in the land, is we're going to make sure that we're getting as high of a basis in that land for our investors in Fund VIII as possible. So more to come on that. But suffice it to say, we wouldn't have stayed in this deal if we weren't very bullish of our basis and this site for this development. I hope that
Okay.
answers questions.
That's great. Thank you. I'm just looking through the questions. We'll allow maybe for one other question. Again, post your questions though, if you wish. Okay, so Greg is asking, just to clarify, Fund VIII will get paid lease on the land then? You want to speak to that, Leo? We're contributing the land to the overall project, not leasing the land.
Yeah, our intent is Pinnacle will still have our same joint venture major decision rights as we've negotiated with Stillwater. Just the capital stack will be, Fund VIII will have approximately a $6 million position, and then that will be contributed into the development. So that will be, with the same, waterfall and agreements that we have with the sponsor, and then we'll have a second fund that will raise for the balance of the equity. But we'll still be managing the joint venture. We'll be the LP partner with major decision rights and control provisions for that development.
Yeah, so just imagine that Pinnacle Fund VIII will have a percentage of the entire project, right? It's the land. It's maybe equates to 20% of the total project, but we're participating in all the upside that's ultimately generated from the project's execution. Okay, well, I think we're near the conclusion of our webinar. We thank everyone for participating. A lot of great questions, very specific kind of real estate oriented questions, which we appreciate. And again, for those prospective investors, please contact us. We can evaluate your 23K1s if that's something you're managing. Certainly, if you're planning any sales of appreciated assets at this time, they can certainly qualify for the aforementioned benefits. And then you now have a great update on the progress made across the portfolio. It's fully constructed, in place, and active. And as you can see, we're cash flowing in NODA, and very soon, later this year, early next in Denver. So this is a performing collection of projects. Thank you, everyone, for your attention, and we look forward to continuing the conversation. Have a great day. Bye-bye.
Thanks, everybody.